Okay, it looks like we're live. Nice to see all of you here already. 123 of you already waiting on the chat. Clive is coming on. Hopefully, I think he's better. He's had a bad back. It's nothing serious, but he was in a lot of pain last week. So the title for the live stream tonight is Germany wants to the rest of its 1,200 tons of gold from the New York Fed. Of course, we're going to talk about whatever you guys want to talk about as well, whatever questions you have. Uh, the markets are pretty chaotic right now. The move in silver, I guess, a lot of you are probably worried about it. I'm not. I'm not worried about it. I don't think Clive is. And yeah, we're going to look at some numbers in the bigger picture and what I think is happening to silver. And yeah, what's going to happen this coming week. So before Clive comes on, I'm just going to say hello to as many of you as possible. Fed Up is here from New York City. Rizard Molenda, Riqua is here from, says, hello, Mario, Rudy, and later Clive. There's Rudy. We had a nice walk yesterday, Rudy and I. We went to the park. He wanted to jump in the lake with the ducks and the geese, but I had to stop him, of course. He was really tired afterwards. We had a long walk. Wendy Bevan is here. Jeff Johnson, Michael Kennedy, Nick Banfield, Hermes, Stefan Chung. Greetings from Germany. Mart uh, D. Dub says, good evening, Mario. Andrew Wilson from Basingstoke. Aaron from Buffalo, New York. Charlie Delano has a question. Who gets interest on national debt created on a keystroke? Investors get that. The Fed gets that as well. They buy treasuries. I mean, you could get interest on it if you bought treasuries. Foreign investors get it. Pension funds, yeah, pension funds, hedge funds, and yeah, anyone who buys treasuries gets the interest. Truth teller, interesting times. Yeah, it is. Brett Piloff from Ohio, Native American, Wendy Bevan. Yeah, I already said Wendy Bevan. Quadrant 72. Yeah, Rudolph is resting as usual, but as I said earlier, we had a over an hour walk at the park, and we didn't take the car. It's not that far from our house, but usually we take the car to the park and we walk around the park. Can Man says best place to liquidate some gold in South Wales, UK. It hurts, but in a financial pinch, buying a home. Um, well, I'm not sure. In South Wales, I don't know who deals in gold, but you can try bullion dealers online. I mean, I have an affiliate in London, Gold Investments. They will buy your gold. Of course, you have to ship it to them or come to London, ship it to them insured. There's other dealers as well. You can look for online if you want to chat to the guys at Gold Investments. There's some details below in the description of this video. They're legitimate. You know, they've been in business for over 40 years. Oliver and Simon Temple, their dad started the business in 81. John 416. Good evening, Mario from Northwest UK. Good evening, John. Henrik Clausen, he who has the gold sets the rules. That's right. I agree with you. Warning sign says good luck with that, Germany. Yeah, well, they did get it did take 4 years for the New York Fed to send 300 tons to Germany from 2013 to 2017. So spot for the New York Fed is 4 years. It's worse than the Bank of England. So is there any gold at the New York Fed? I don't know. I used to have a client at the Treasury. Citibank Treasury in New York was one of my clients, very nice guy. And he used to tell me that he used to go to the gold vault at the New York Fed every few months to inspect things. I'm not sure. I guess Citibank kept some gold there. Citibank owns part of the New York Fed, but I don't know if that gold's still there. They even have a website on their website, I think the New York Fed, they showed their gold vaults, but who knows? Question from Charlie Land, do tariffs fix anything? And what happens to the tariff money? Well, the tariff money goes to the government. It's charged at customs. Uh, customs charges the tariffs to it charges the importing company in the U.S. It actually doesn't charge the foreign companies that export the goods. So there you go. But we're going to look at tariffs later on today. Clive has got a good list about what tariffs do, not just to who gets the money, but how it affects everything. Oh, here he is. Clive is just coming on. Hi, Clive.
Hello, good evening, Mario.
Good evening. You doing better?
Yeah, so I think you're live now.
Yeah.
I'd like to say thank you very much to all of your listeners who wrote to me on LinkedIn to wish me to get well. That was really nice of you. Thank you very much. I had a terrible back pain. I went to hospital. It was so bad. They did all the tests. It was really, really fast. They found nothing wrong, so they said it's a pinched nerve, most likely, and take some painkillers. And that's what I'm doing.
Great. That's good. Well, not great that you had, but great that you were feeling better. Yeah, back pain is not nice. I've had back pain in the past. Thankfully, I haven't, knock on wood, I haven't had for a long time. Someone asked Clive about tariffs, you know, who collects them and who pays for them. And I said that usually the way it works, the customs in the country that is importing stuff, they charge the import. Let's say someone in the US buys shoes from China, and the importing company in the US, they will get the shoes, let's say at $100, and then the customs will charge them 20%. So the importing company will have to pay $120. So the Chinese company actually doesn't pay anything. It's ultimately the importing agency or the importer, and then the importer will have to sell it instead of selling it for 105 to a wholesaler or a retailer, he's going to sell it for 125. So ultimately, it's the U.S. consumer that will end up paying for it. And I think Trump and Besson admit that, but they say that it's going to be temporary and that eventually trillions of dollars of investments from abroad are going to come to the US to build factories in the US. But I'm not too convinced about that second part. So I'll let you chime in.
So the usual way is it's the shipper or the importer who's got to pay it. Now, under the US rules, it's going to be the shipping company who's responsible for it. So effectively, anybody who's shipping goods to the United States will now have to pay a shipping duty, uh, or rather, not shipping duty. The shipping company will have to pay the shipping duty, and that will be passed on to the American consumer.
Yeah.
But at the end of the day, it's the consumer in America who pays the tariff. It's not the exporter. The exporter might reduce his price or might not. But if the exporter doesn't reduce, well, whether he reduces the price or not, it's still the consumer who has to pay the tariff.
And the tariff goes then from the shipping company to Uncle Sam. So I'd like,
Yeah.
yeah.
It's actually all set out in words of one syllable in the US press release about the tariffs. I haven't got it in front of me, but basically they're specifying exactly how it's going to work when things come into the United States. Actually, there's one thing which I think a lot of Americans haven't realized, which is going to upset an awful lot of Americans, and that is the duties which will apply to low value postal items coming into the United States from China. Historically, anything coming in worth less than $800 by post wasn't taxed,
Mm.
but now they propose to charge immediately a duty of 30% plus $25,
Mm.
rising to 30% plus $50 on the 1st of June. So if you're buying yourself some batteries or a torch or some little toy for your kids, it's going to cost you not only 30% more, but it's also going to cost you the $50 import fee for that postal package, even if it was only something costing a couple of dollars.
Yeah, I mean, I used to, I don't do it anymore, but I used to buy some shirts from a US website, like golf shirts, and there's no VAT. But now when I go on it, let's say the shirt is $75, there's the shipping, and then there's 20% VAT that they charge here. So I think that's the other thing the Americans have been complaining because they don't have a VAT on imports. So it does seem unfair. But Clive, let's change topic for now, but we'll go back to tariffs because you wrote something interesting about it. What I want to talk about now is this is not really it's just kind of rumors, but the reason I bring it up is that I don't know if you remember, Clive, back in 2013, Germany demanded 300 tons of gold. It had, well, it had 1,500 tons with the New York Fed, and it wanted 300 tons repatriated to Germany, to the Bundesbank in Frankfurt. And it took 4 years from 2013 to 2017 for the New York Fed to deliver 300 tons. So their spot delivery is even worse than the Bank of England. And now, with all that's going on tariff-wise and trade wars, it looks like the new German government is considering withdrawing the rest, which would be huge, I think, 1,200 tons. Some people are saying, well, good luck with that, Germany, but I think it would hurt the reputation of the New York Fed and the United States if they dragged their feet uh, in sending that gold. What's your view?
Well, the trouble with letting somebody else look after your things for you is when they've had it long enough, they start to think it's theirs. So, I want to, imagine that one of your best childhood friends when you're a child and you made a bit of money and he wants to buy a house and you lend him, £10,000 or £20,000 to buy his house. And the years pass, the decades pass, and 40 years later you come along and say, oh, by the way, remember that £10,000 I lent you? I didn't charge you any interest, but do you think you could pay it back? Well, the friend's going to sort of say, oh, you didn't ask for it back. I thought it was mine.
Yeah.
So, that's I always say, if you ever lend something to somebody, at least charge a peppercorn in rent or interest. So if you lend someone £10,000 and it's, let's say, you're a member of your family or somebody you love dearly, and you don't really want to charge them interest, you should still make them pay, let's say, $1 a year or £1 a year, because that way you keep the memory that this is actually a loan and it's not a gift. And of course, what has Germany done? Like so many countries, they've literally handed their gold to America, said, "Look after it first." And America's sitting on this, and it's in possession is 9/10 of the law. Now, I'm quite sure America, in any because they're a civilized country, will give it back.
I'm not.
But
I'm not too sure, Clive.
but
Know a lot of this. Can I just add something, Clive? I'm sorry to interrupt.
well, what we don't know is why, when Germany asked for it last time, why did America drag its feet, or did they drag their feet? I mean, why did it take 4 years? Was it because it was difficult to arrange the security? What was the problem? But it seems to me that if they wanted it back last time, they should have got it back immediately. And why did it take 4 years? I don't know.
Well, I think it took 4 years because the New York Fed probably lent out the gold many times over, and they needed to cover it slowly. And maybe maybe the gold wasn't there, and they took a while to buy it back. They didn't want to like spook the market. But the thing is, this is the vestige of the Bretton Woods system, and Germany ran a lot of surpluses up until 1971. And Germany, West Germany at the time, they kept they how can I say they converted a lot of their dollars currency reserves into gold because you could do that, and they kept it at the New York Fed because it made sense under the Bretton Woods system to keep it there. So, like you said, though, it's been there for so long that the Americans even think that it's theirs now, maybe. And I think it took so long because uh, a lot of this gold is leased out so many times over, and it probably had been in London leased out through the LBMA. And if they rushed to get this 300 tons, it would have driven the price a lot higher. It goes to show, Clive, that I think the situation in the paper market is very leveraged.
Yeah, I mean, I think it's well known that foreign governments, when they deposit their gold with a custodian like the Bank of England or the New York Fed, that they authorize it to be leased out because that's a way of earning some extra interest and paying the charges for the custody. We heard the Australians say it a few months ago when they were questioned about the gold held in London, the fact that the gold bars they were getting back weren't exactly the same bars as they deposited. Well, the reason which came out was that the Australian government had authorized the Bank of England to lend it out so that they could earn some interest. And of course, when you get the gold bars back, you're not getting exactly the same bar back. You're getting a different bar, but the same weight. So I really believe that it's quite likely that Germany has authorized the New York Fed to lend out their gold. Obviously, there's a gold lending market out there, and of course, it might well take time to get it back because if they lent it to the gold miners, it means the gold miners have either got to borrow it from somebody else or dig it up to get it back, and that
Yeah,
takes time.
yeah. Um, it's really interesting because in 2018, the Bundesbank, which takes stores Germany's gold in Germany in Frankfurt, they even came out with the book Germany's Gold to talk about those 300 tons and how gold is important. And I bought this book. I think in 2018 it was 30 euros, but it's a beautiful book, Clive, with loads of pictures, as you can see here, of the Bundesbank gold. So it was a big campaign because the German people really wanted their gold back, and they only got 300 tons from New York. They got some back from London and from Paris as well. But the Germans like their gold. And in this book, Clive, they also talk about the history of money, which is really interesting. Uh, so here you go. I recommend if people want, they should look this up on Amazon, Germany's Gold. So maybe they're gonna be publishing another book for the other 1,200 tons. I don't know. Terry Pelletier, thank you for your super chat. He says new goldbacks coming. He said that twice. Thank you. You know the goldbacks? They look like banknotes, but they have gold in them. I don't have one.
I've never seen one or never seen an original. I've seen the
Yeah.
photograph. Yeah, obviously, if the gold is worth what it says on the note, why not? But
Yeah.
I'd rather own a physical coin because that's
Yeah.
much more visible to me.
I think they're legitimate, but it might be nice to buy some, but I don't have any. Clive, let's talk a little bit about silver because prior to this week, and I've got some, let me bring this up. I've got some data here. So let's have a look. Where is it? So first of all, well, let's look at silver and gold, what the metals have done so far this year. And prior to this past week, as you can see here, in the last week, silver lost 16%. So year to date is just pretty much unchanged now. While gold in this week actually only lost 2.5%, which is pretty good performance, and it's still up 15 on the year. But if you look at all the other metals here, they lost massively, like copper, uh, aluminum or aluminium, nickel. So what it seems to me, and I was listening to Michael Oliver, he did an interview with Liberty and Finance. He said people are treating silver as a purely com how can I say industrial commodity. They're not looking at the monetary part of it, and that's what he thinks has happened. It makes sense to me, and that's why, Clive, I'm gonna stop sharing this now, and I want to show you and the viewers how worried I am about silver. I still got my
A 1 kilo bar I see there.
yeah, and I've got some Australian kangaroos. I've got US Eagles. So that's how worried I am about silver going down. What about you,
Well,
Clive?
I remember when way back when this would be when I first arrived in Switzerland. We're talking 30, 40 something, 40 years ago. We used to use those 1 kilogram bars as paperweights on our desk. You wouldn't leave one of those on your desk anymore.
No, no. Yeah.
So the silver, nothing goes up in straight lines. The silver price has had a major dip this year. Obviously, it's well up on a year ago. Um, I'm not worried. I think the supply and demand on the industrial side is in favor of silver going higher over time. I think that will happen. In the meantime, I think in the short run, we've had the news on the tariffs that this will not apply to silver. So there were probably a lot of people in America who use silver in the manufacturing of electronics and things like that, who'd bought up extra supplies of silver ahead of in fear of tariffs on silver, which doesn't apply now. And so now we know where we stand on the tariffs. They've taken their foot off the pedal, and that the demand has for that silver's fallen away because they've all got stockpiles of it. I think it's temporary. I think it will revert in due course. But we're in a funny period now because the price of equities are falling. I personally believe we've got further to go, although markets have a tendency to sort of surprise sometimes. But when equities go down, everything should go down with it. The exception to that this time, and this is unusual, I would say, is gold. Gold has not been falling. I mean, it has fallen, but it's not. It's hardly there's hardly any fall at all, really. And I think the reason for that is there must be central bank buying going on, and central banks are quite, they just don't care what the price is. It's they can print some money and buy gold, and I would reckon that a lot of central banks are now seeing what's going on with tariffs. They're going to say, well, we're going to have less exports to the Americas. We're going to have less dollars. We won't need to have so many treasury bonds. In fact, we can't really trust where we are with the treasuries now. So I think they're starting to, they're probably not just starting, they're carrying on with their buying of gold. And I think that's what's supporting the price of gold. The man in the street is selling his gold. There's no doubt about that. And the reason he's doing that is because he's getting the margin calls on his stocks, and he's also in the field of bottom fishing. So he's looking at his stocks. Almost anything he bought in the last year is less than he paid for it, and he's saying, "Well, Oh, there's something which is up. I've got some gold or gold ETFs which are up, and he's selling that to raise some cash to do some what they call buy the dips. But those dips, the rallies we get ahead after each dip will be quite shallow, and it won't be very long before the man in the street has he'll have sold his gold, he won't have any left to sell, and he'll have bought the dip, and the stocks will be down. And meanwhile, I think by then the gold price will be rallying.
Yeah, I don't really see the man in the street having any gold, but maybe he is. I think it's probably more speculators and people who leveraged themselves a lot, like hedge funds who had to maybe sell some gold. But yeah, anyway, someone's asking a question here, assuming the Thursday, Friday price decline was only really due to margin calls, is it likely that most calls have already been responded to and so unlikely to see much decline this week? Um, I guess you're talking about the stock market or silver. I mean, a lot of people always say that gold and silver go down because they were making money on it, so they can sell that to cover margins for other stuff. I'm not too convinced about that. I think the bullion banks they were involved again, especially with silver because silver is a small market and they bashed the you know bashed it with a lot of paper and then it triggered stops. But I don't think it's over by any stretch, Clive, this market turmoil, because I'm hearing as well, I've seen that the banking indices are doing even worse than the general stock market. I'm hearing that like junk credit or high yielding bonds are starting to look fishy. So I think there's going to be a lot of margin calls from the banks to their clients in the coming weeks, and I wouldn't be surprised if we hear of some kind of institution failing soon.
Yeah, I mean, whenever we have a sudden lurch in prices of anything, there's always going to be someone at the wrong end of it. And I mean, obviously, there were lots of people at the wrong end of it, but there'll always be somebody who's excessively leveraged in the wrong way at the wrong end of it. So, yes, I think it's quite likely we're going to hear about some sort of failure. It could be a hedge fund, it could be some big institution. Who knows? But it kind of seems to happen every time we have a lurch in prices of anything. And this time, what's the lurch? Well, we're seeing the Mag 7 drop a lot, and of course, the rest of the stock market falling with it. So, it wouldn't surprise me to discover that there's some leveraged fund who is excessively long and gets caught at the wrong end.
Yeah, so I just want to show some other to give people some perspective. Um, we I was talking about the banks, so that's the KBE index. So year to date, it's down 15.7%, right? So, and let's now look at the GDX, Clive, because yes, they've come off, but look at the GDX year to date. It's still up 18%. GDXJ up 14.6%. And then you look at the stock market, the Dow is down 10%, S&P is down 13%, and the Nasdaq almost 20%. And even the silver ETF, I mean, that's just about flat on the year. So I'm not concerned. Hopefully, this coming week, I'm gonna put some more money into my ISA because it's the beginning of the tax year. I couldn't put any more. Uh, there's a 20,000 pound limit per year, and hopefully I'll be buying some more silver miners, maybe some more physical silver as well.
Well, I hope everybody can just press that like button so you can afford it, Mario.
The like button doesn't really pay anything, does it? But what do you think? Is that I mean, you've said in the past because you've gone through a lot of these market events in the last 40, 45 years, and things always seem to recover eventually. Um,
Well, yeah, they eventually they will, and they do. Um, you know, if I talk through this crisis, there's quite a lot of steps, but the final step, which we will get to, is when the central banks step in as lender of the last resort to the government, who will be having trouble raising funds to finance its debt.
Hmm.
That'll be not just the USA; it'll be the USA and other central banks following suit. When that does happen, we're back in QE again. Money printing will have gone mad. The money supply will be going up, and asset prices will be rising. Uh, Long before that actually happens, people will be anticipating that it's going to happen. So the stock market itself should rise long before the central bank steps in and starts doing QE. Uh, so, because that's what the stock market does, it anticipates events long before they're happening. So, to give an example of that, let's look at the COVID crash we had in March 2000. The stock market plunge. It was I can't remember how much it was, a tremendous plunge because COVID was coming out. We're going to lock down and everything was going to shut down. It was going to be terrible. The whole world was finishing. Airlines were bust. Hotel companies were bust. Cruise liners bust. Holidays were bust. Restaurants were all going to close. Hairdressers couldn't operate. The whole world was shutting down and it was going to be a disaster for the stock market. The stock market crashed and it was just going to get worse. And you had people ringing up saying, I think it's going to get worse. Sell everything. And guess what happened? It turned out to be the worst day. And then it went straight up from then, even though we had another 3 years of COVID ahead of us.
Yeah.
So, sometimes, I never say that we know exactly what is going to happen tomorrow. I don't know. I think we're down. We've got another at least 10% or so on the downside, but I might be wrong. For all I know, somebody in the White House is going to stand up and say something wonderful tomorrow. I doubt it very much, but you never know. And if this happens, we might, or maybe Chairman Powell will come out and say we're having an emergency meeting and we're going to reduce interest rates tomorrow. We don't know. Um, so if something happens which we don't expect and it's a positive thing, of course the stock markets could turn around on it, turn around on a sixpence and shoot upwards. I don't think that's likely. I think we're probably going down, and I'm guessing perhaps another 10%. But I've heard lots of people saying it'll be another 70% or 50%. Well, we'll see.
Yeah, yeah. I mean, in the last 40 years, since the early 80s, yeah, buying the dip in stocks has worked very well. But there comes a time where things might not uh, always work. And I have to go back to 1929, that crash, and the stock market bottom in, I think, 33 or 32. And then it took until 1954 to reach that 1929 high. So 35 years. I'm not saying this is going to happen, but it's a possibility. But back then, Clive, they didn't. The Fed wasn't as didn't interfere as much, and we still had like an international gold standard. Now, uh, I don't think they care much about. I think they're so used to and addicted to printing and government borrowing that they won't let the things get out of hand to the downside. Someone's asking Clive Sybil Faulty, Mario, can government grab ISIS? Well, anything's possible, but what they can do is cut the amount of that you can put in ISIS. There's been talk about it, like from 20,000, they could cut it to 10. But actually grabbing my account, I think the world would have to be a lot worse for them to do that because it's pure theft. It's like going into your bank account and grabbing your money. But you never know with the socialists and communists that we have in charge in the UK and Europe, what they will do. What do you think, Clive?
Well, they don't need to grab your money to steal from you, Mario. All they have to do is print a whole lot more money somewhere else, and your money is worth that much less or buys that much less.
Yeah, and that's why you have to keep not just silver, but also a little bit of gold.
Yeah, they can't print gold, can they?
No, no, and make sure it's yeah, not ETFs, it's physical. because they could come after that actually, the in the stock market. And there is counterparty risk, right? Clive, all these ETFs are run by the banks, and they could use force majeure or anything to kind of not pay you.
Um, this is true. I think if you do have to invest in an ETF, because not everybody can keep a large amount of gold buried in their garden. Mario, you're very lucky you have a garden, I suppose. But lots of people live in apartments and maybe don't have a garden to bury it, and they have to keep it under their pillow. So they might not, they might not have much of a choice. So they've got to either have a safety deposit box at the bank, which that means they've got to go and get it if things start to go nasty, or they're going to say, well, for simplicity reasons, I'll just buy an ETF. So if you're going to do the ETF, make sure or think carefully about which bank you're going to buy it through, who's going to be your custodian, and in which country they are, and which country the ETF is, and in which country the ETF is storing its gold. These are all questions to look at. If you get the fact sheet for any of the ETFs, you'll find the answers to those sort of questions, and you can make up your mind whether you trust the country and whether you trust the location of the gold.
Yeah. Clive, you mentioned earlier someone in the administration coming out and saying something. So we had today I saw on Bloomberg this story. Uh, Here we go.
Oh yes, yes, he did.
Besant defiant on tariffs as he rejects a U.S. recession. I mean, if the stock market drops another 10%, I mean, I don't see how they can escape a recession. Uh, yeah, and yeah, I think they're like assuming too much that things will work out. You
I
know,
mean, he's got to say the right words, but I personally believe that we will have a recession, and it won't be just the USA; it'll be global. Things will slow down. I mean, let's face it: everything is going to cost more, and it
yeah,
doesn't matter where you are on the planet; it's going to cost more
yeah,
now. So people have only the wages have not gone up, but the cost of things have gone up. So what does that mean? It means that people will buy a smaller quantity of things. Therefore, the production goes down. And as the production goes down, it means that some companies are no longer making any money. There'll be layoffs, there'll be redundancies. Some companies might even go bust. I mean, they are going bust already to some extent, but there might be more going bust. Certainly, the profit expectations of many companies will be going down. That, of course, is not, in general, not seen as a good thing for the stock market when companies reduce their profit expectations. And when that's happening, people see the value of their savings accounts, their retirement accounts, and their investments going down, and they tend to draw in their horns a little bit and spend less. So that basically means that, in my opinion, we're going into a recession. I think we'll come out of the recession and we go in at one end, and then we go through a rough patch, and eventually, as the unemployment rate rise, the number of people who are unemployed rises, the central banks start to ease up. They'll lower rates multiple times, and the reason they'll lower rates is to try and stimulate the economy. And as that happens, then there'll be a little bit of a pickup in the stock market, and then of course the government will be finding it's got difficulties to borrow money because people aren't willing to lend it money when its debt is increasing very fast and its tax take is falling. So what then happens? The central bank steps in as buyer of the last resort of government debt, and that basically is QE all over again. Money's being pumped into the system, and we're all off to the races again. And gold, of course, will be when we get to that point, gold will be going through the roof, and the stock market will also be going up for quite some time at that point.
yeah. And I brought up here the Fed's total assets on its balance sheet. This was the COVID money printing here. It went all the way up to almost 9 trillion. And I saw Kyle Bass, who I don't follow very closely because I don't agree with almost everything he says. But in this case, I thought it was good. He said no one's mentioning this chart here, the fact that the Fed is draining all the liquidity from the system. And maybe that's why the stock market is keeling over. And I kind of agree with him. Like here, they started draining the liquidity, unwinding the balance sheet. And then all of a sudden, it created the repo crisis and then COVID. So I actually think COVID was a bit of an excuse and a cover to save the system. And I think they might use the tariffs as an excuse, Clive, seeing that, we've spoken about this, and many people speak about how the stock market was over 200% of GDP in the US. Like we have an everything bubble, the Magnificent Seven. So this could be just a normal collapse of the everything bubble, and they're going to use the trade war and tariff as an excuse to maybe we could be at I don't know 25 trillion by the end of the year. I mean, I wouldn't put it past the Fed or by the end of next year. Do you think that's too extreme, or you think that's possible?
First of all, I think the central banks will throw away their inflation target. I think they're going to say, yes, inflation is going up because of what's going on in the world, but it's a one-off event. It's not related to it's not related to our actions. It's related to something which happened once off and it's not going to be repeated. Therefore, we can ignore the rise in inflation and we will concentrate on our other mandate, which is maximizing employment. And the way we do that is by reducing interest rates. So they're going to, yes, as a first step, they're going to reduce interest rates. And if that effectively that's pumping money into the system anyway, and it's easing conditions. But of course, the follow-on from that is as the economy, which will continue to get worse for a while, they will have to step in to help the Treasury or the governments of the world. It's not just the USA, by the way. The central banks will have to step in to help their governments finance their debt because nobody or no government wants to see higher rates because they're already paying considerably higher rates on the maturing debt that they took out over the last decade when interest rates were effectively zero. So the rates they're paying now when they roll over that debt are already high. They really don't want those rates to go any higher. So the only way you can stop it going higher when, for example, if we take the USA, the foreign central banks are saying, well, we don't have so many dollars now because we're not exporting to the USA as much. Therefore, we're not going to buy as many treasuries. So the natural buyer of treasuries won't be there. So the American public, who would be the other buyer, are going to get indigestion. They won't be able to keep buying treasuries. So at the end of the day, as they need to refinance themselves, they're going to have to turn to the central bank and say, please help us out. And that's what the central bank will do. And the way the central bank helps out a government fund its debt is basically to print money and buy government debt. And that's when you see that on that graph you showed, that chart you showed of the central bank balance sheet, the Fed's balance sheet. That's when the size of the balance sheet gets larger, and I think that's what's going to happen down the line. I think we're perhaps 6 months away or a year away from that, but I think that's what's coming.
Yeah, there's questions here about the price of gold, and I would say I'm not really concerned. I think people put too much importance on price. I look at it more as an insurance. Yeah, it's nice that it confirms our belief. It's not like the gold price that moves, it's the price of the fiat currencies that drop or rise. So Fletch is asking, Mario Clive, do you think gold will go below 3,000 or that's the new floor? I don't know, Fletch, what the floor is right now, but I'm the thing is, this is like back in 2020 or 2008 when I remember in '08 when gold dropped from just above 1,000 in March to like 680 in September. when Lehman collapsed. Uh, and you've spoken about this, Clive. It was really hard to get gold at 680. You had to pay like 10% premium if you could find the physical. So, yeah, that's the way I.
Well, and the other thing is when these sort of things happen, when everybody's looking to get their hands on gold, there's delays. You'll because the refineries suddenly find that all the gold they've made is sold and they can't make it any faster. So the demand for bars or coins exceeds the supply. So these sort of things do tend to trade at a premium
Yeah. I
if you could get it at all. I mean, I recollect an incident when all the banks were failing. It must have been 2008 or
yeah, it
thereabouts.
was '08.
Uh, and one of my clients rang me up and said, Clive, I think the bank's going to fail. I want you to put all my money into gold, physical gold bars, which we would store for them. That would be something which is not on the bank's balance sheet. That's fine. So this is the sort of thing in Swiss banks. We do that every day. We buy gold bars every day and sell them every day for clients. It's just part of Swiss banking. So I rang our forex dealer who deals with the gold bar purchases, and he said, "Yeah, no problem." And then about 10 minutes later, he rang me back and said, "Oh, sorry, Clive. We can buy the gold bars, but we can't get delivery for another 14 days,"
Yeah.
which was unusual because normally when you buy a gold bar, you get next day, you pay the next day and you get delivery the next day
Right.
into our banks. And then we put it in the client's vault with a little yellow sticker on it saying belongs to Mr. Jones, whoever it was. I mean, I'm being a bit facetious with the yellow sticker bit, but obviously it's allocated gold. It's not on the bank's balance sheet. But of course, the problem with my client was that he wasn't going to get his gold for another 14 days, which meant we even though we would have bought the gold on his behalf,
Mm.
he was at risk because the gold hadn't been delivered.
Yeah. Oh, I just want to show this chart here. A second, Clive. This is the Dow gold ratio. I mean, this is going back quite a while. I just want to show it's like a megaphone. And I think eventually we're going to go back down to around 1 to 1, maybe even less. But the reason I wanted to show this is because what's happening now. So people are concerned, people are asking, oh, is gold going to hold 3,000? But well, gold is doing very well because the Dow here, as you can see, closed at the Dow gold ratio closed at 1261, which is the lowest level since 2020. So I'm not saying it's going to go down in a straight line, but I can see over the next few years this Dow gold ratio cascading back down towards 1 to 1, and I think that's when we get near to 1 to 1. That's when maybe you maybe exchange some of your gold for other assets, paper assets. But right now, I think it's still the place
You,
to be.
in answer to the question about it will gold go below 3,000, obviously you and I don't know, we don't know. But in a way, I can answer that. I think that if the central bank buying continues, as has been the case over the last year or so, and I think there's every reason why it probably will continue, even more so now. If the central bank buying continues, I think gold will remain very well supported. But of course, if the central bank buying dries up, at the moment, there is there's not a strong enough flow from the investing public at large to keep the price up. So, if the central banks were to withdraw, yes, the gold price will go down below 3,000. It's not something to worry about because it's just a question of time before gold starts to find its way into the asset allocation tables of investment managers. I mean, I've been working in investment management for nearly 50 years, and I know how this works. The asset allocators, that's a different department from the investment managers, put together ideal scenarios of portfolios. We've all heard about the 60-40 portfolio, which is 60 equities and 40 bonds. And of course, there's other assets in there like alternative investments, and obviously gold could be in there, and high yield could be in there, and structured products could be in there. So, but basically, they put together a portfolio and they stress test it against all scenarios by looking at what's happened over the last 5 years, 10 years, 2 years, 20 years, whatever they like. And based on what's happened over the last 20 years, they determined what would have been, past tense, the optimal asset allocation to have the best Sharpe ratio. Now, the Sharpe ratio is a ratio which is the best balance of risk and return for a particular type of portfolio, like a growth portfolio or a balanced portfolio. So, what they're looking for is the best return with the lowest volatility or the lowest risk. And when they're doing these asset allocation tables now and rejigging them, they will find that adding a little bit of gold to a portfolio will improve the Sharpe ratio. So as these portfolios get relooked at on an annual basis and the Sharpe and the asset allocation gets looked at, they will start to add larger and larger quantities of gold. And when I say larger quantities, I mean we're starting at zero, going to 2 or 3 or 5%. I don't think many banks will go to 7% or anything like that yet. But that gold will be finding its way into portfolios because mathematically, over the last decade, it would have been a good asset to have in the portfolio because it would have reduced the volatility and improved the returns. So I think it's coming, but it will take time. And as that does start to happen, then I think that the gold, it doesn't really matter what the central banks are doing, the gold price will be rising anyway.
Yeah. Um, Ounces is saying, thank you for your super chat, Ounces. He's actually got this app, Clive. Did I tell you about it? Ounces.
Never heard of it.
Yeah. Have you got Apple or Android?
Uh, I use Apple.
Yeah. If you look at the app Ounces, you can put in how many ounces of gold and silver you have, or platinum and palladium, and it updates every second how much it's worth in Swiss francs or pounds, all the currencies. I recommend it. And I recommend the viewers as well check out Ounces. But he says,
Sounds like a lot of fun.
yeah, he says, in addition to Germany, what other countries have a meaningful amount of gold stored in the US that may be at risk of repatriation? Yeah, I think there's quite a bit of gold at the New York Fed. I think I heard there's like 3,500 tons, maybe not as much as at the Bank of England. So yeah, all the gold at the New York Fed is not owned by the US. It's foreign central banks and foreign institutions. Do you know more about that, Clive?
I don't, but I do know it makes it historically, it's made a lot of sense for countries around the world to store some of their gold in London and some in New York. And the reason for that is if your country gets invaded, the first thing the invader is going to go after is the gold you've got in your central bank vaults.
Yeah.
So having some of it overseas makes a lot of sense because you might need to spend some of that gold to buy yourself weapons or something to defend yourself against the invasion. So it's quite normal that countries have kept their gold in places like New York, and there probably is a lot of it from lots of countries. I mean, we've obviously heard about the problems the Venezuelans have been having getting their gold a few years ago. Now, the worry that many central banks be having now is can we really, really, really rely on getting it back if the push comes to a shove? So I think there will be a tendency for central banks to and governments to say we'll have a little bit more of our gold at home, but I think they will still keep some of it overseas.
Yeah, I mean, and the other thing is, well, with what is going on right now in terms of the tariffs that Trump is imposing, with Trump talking about uh, annexing countries and things like that. If I was in charge of a central bank or a treasury, and this country, and we had like loads of gold in New York, I would be worried about it, actually. I wouldn't trust. Uh, I mean, the Americans, they defaulted 1971, Clive, because, well, Nixon defaulted. So I don't think we can trust them.
I
And
mean,
I'm
there was
not
there
saying that
so,
because I don't like Americans. I don't trust the banks in America, and I don't trust the banks in the UK or anywhere else.
well since 1944, which was the Bretton Woods Conference, every country in the world agreed that they would keep dollars and use dollars for international trade instead of gold because they were absolutely 100% persuaded by the Americans that you could always convert your dollars back into gold anytime you wanted at $35 an ounce. Now, maybe that wasn't a legal obligation, but it was certainly a clear understanding by every country that that was the situation. And in practice, it worked for decades until we got to the late 60s and it started to get a little bit more difficult to get your gold. And then, of course, by 1971, I think it was in August, after several countries had actually got their gold a little bit earlier in the year, America said sorry to, I can't remember who it was now, I think it was France. Yes, it was
And the
France.
UK as well, Clive.
That's right. Yeah, they said sorry, you can't have it because if we give you your gold, there won't be enough for everybody else. So you can have dollars for your dollars. That's it.
Yeah, I think the UK had like 2,600 tons. They were able to take 600 tons out, and they lost the other 2,000 tons. And the
That's right.
600 tons, eventually, Gordon Brown sold half of it, and that's why the UK only has 310 tons now. But so there
And
you
I
go.
think Switzerland was quite lucky. It got something like $500 million worth of gold out just in the weeks before they closed the window.
Yeah. JM is asking, Mara, can you elaborate on more on the interest rate spike that you talked about on Saturday's video? Yeah, Clive, I don't know if you noticed, the 10-year yield on Friday dropped all the way to like 3.86%. And then at the end of the day, though, it rallied back, excuse me, back up to 4%. So that means people were selling treasuries. And that's despite the fact that the stock market uh, finished right on the lows and at the end of the day. So I thought that was, yeah, that was kind of a bad signal for the markets because it, yeah, and for treasuries because maybe people are not perceiving it as that safe. What do you think?
Well, it's interesting because at the moment I just refresh everybody's memory, we have hit the debt ceiling on the 1st or 3rd of January this year, which means the government is no longer able to borrow any money. So what's been happening since the 31st of January, they've been running down their cash reserves and raiding the government pension plans to fund their spending, their overspending, if you like. Now, that those sources of funds are going to run out most likely in August, by which time they'll probably have raised the debt ceiling, although I'm not hearing any debate about it. But let's assume that they do raise the debt ceiling. I mean, it'd be much, obviously, the consequence of them not doing so would be a default, and that would be really terrible. So we'll assume that they will raise the debt ceiling by August. When we get there, they're going to have to refill the Treasury coffers. That's $800 billion, which will have to be found in very, very short order to put things back into kilter. And we're in a world where foreign governments have been showing reluctance in the last year or two to increase their holdings of US government debt. And now with the trade tariffs, it's likely that some governments will have to will not some will have to and some will decide to reduce their holdings of US treasuries. So the natural buyers of US debt won't be there. So the question I've got is I wonder who's going to buy all of that $800 billion of debt, which will suddenly be needed. And then, of course, they're going to have to keep funding the deficit from then onwards as well. Yeah, I think we're going to see higher interest rates on the US government debt, and we're going to see higher and higher interest rates until we reach the point of too much pain. And at that point, the Federal Reserve will be forced to step in and start buying government bonds by printing money.
I was muted. Uh,
Yeah, I was
for
looking at you,
fi-
wondering if
yeah,
you've frozen.
this is for 5% because I was listening to the Treasury Secretary. He did an interview with Tucker Carlson, and he said when I was appointed on January 28th, I was concerned because the 10-year yield was almost at 5%. It was 4.8. And so he showed his hands, Clive. because he said, "Yeah, I don't want to see that above 5%." And I think who's going to be buying the 800? Is it 800 billion or
Yeah,
billion?
800 billion.
Well, it's going to be the Fed. I think the Fed's going to help out. It's not going to be China or Europe. Uh,
So where does the Fed get the money? It prints it.
yeah, it just creates. They call it reserve money out of thin air. That's what central banks do. Uh, Andrew Arama is asking, Clive, why wasn't a warning back then when gold wasn't able to be repatriated from the US, i.e., compared to today, the seizure of US reserve assets pushing countries towards BRICS? Well, it was a different world because no one expected Nixon to close the gold window. And
Well,
there
and also your viewer probably wasn't watching you on YouTube in 1971, Mario.
Yeah. No, but also in 1971, uh, uh, yeah, they kept it under wraps, but the France, the UK, and other countries were withdrawing the gold, and it was very fast, and the US Treasury was running out of gold because they're hu running huge trade deficits. So they had two choices. I think I heard from John Exter. I read John Exter, one of his articles, because he advised Paul Volcker, who was at the time worked at the U.S. Treasury. I think he was Undersecretary for International Affairs, and he told Paul Volcker, you can do a few things. You can raise the price of gold, right? So that you devalue the dollar, or you can raise interest rates, which politicians hate doing, or you can just default, and they chose to default. But nowadays, gold is not as important in the system, so they're able to do more things like that because, yeah. Yeah. So, what do you think, Clive? Why didn't they warn back then?
Well, the way you got your news back then was to read the newspapers, and of course, not all journalists were as switched on as people like you and many of your viewers are, Mario. So that obviously they had financial journalists who wrote about these sorts of things, but the information flow was just not like it is today. Now you can flick a button and you can see news sources from all around the world and opinions, and you can draw your own conclusions as to what's really going on. Back then, I think it was probably kept fairly hush hush, and it certainly wasn't being reported by the major news organizations. I'm sure if we looked in the New York Times on the day or the week before devaluation, we wouldn't find anything about it.
No, that's right. That's right. It was a big shock, I think. Um, and let's see if we got more questions here. Uh, JM says if we see the same as 2008 crash, then gold and silver should decline in price, and the bottom of the stock market will be the low prices for gold and silver. Um, I'm not so sure. I'm not convinced about that. A lot of people think that will happen, but as we saw, gold is still up 15% on the year. The Nasdaq is down 15. And the situation is much worse now than in '08. There's a lot more debt, a lot more leverage. Um, yeah, anything's possible, but I'll be trying to stack as much as possible, as usual, whenever I can.
Well, the silver price has dropped a lot from 33 to 29 something. I would say this is a great opportunity to pick up some before the price goes back up again. Now, I'm not saying it won't go lower. We don't know that, but because obviously we're going into a recession, and that does mean that the demand for even electronics might not be as high as it was, but we will still see more electronic devices this year than last year and every year going forwards. So that deficit of silver, which we already know about, where we know that the industrial demand for silver exceeds the mined supply, and the gap is since 2 or 3 years now, and the gap is getting bigger. We know that gap is going to get bigger. It may just not get bigger as fast as it was. But I think the recent dip in the silver price, as far as I'm concerned, I'll be on Monday morning. I'm going to be ringing up my regular silver dealer and saying, "Have you got any coins that have come in from people who are selling?" Because I might be interested in buying them. And if he's got something nice, I'll go along and buy them on Monday.
Yeah, yeah. Um, Someone's saying liquidation, not liberation day on stock market. Uh, yeah, I mean, how do you see this, Clive? Do you think it's so, is it really that simple? Even though I've seen some headlines that countries like Vietnam and Taiwan, they're willing to lift all their tariffs on the U.S. and negotiate now. Do you think
Uh,
that's one of Trump's strategies to make everything so bad that people they will back down?
I don't know if you've heard Scott Bessent's response. That was today, I think, where he basically said it's not as simple as that. They've had decades of abusing us, or words to that effect. I don't know if he used the word abuse, but anyway, that's how it came across. And so you can't just turn things around tomorrow. He said, "We'll see what they've got to offer, but nothing's going to change anytime soon." That was kind of the words. I mean, I find what America is saying a little bit disingenuous here. I mean, for decades, they've been printing money and buying foreign goods with American paper. So, as a whole, citizens of America have had the opportunity to buy lots of very cheap goods, live a very nice life where everybody else in the world has a lower standard of living.
Yeah,
And now to turn around and say that these foreign governments were abusing us, when in
yeah,
fact it was the Americans who were printing the money to buy, and handing out paper. It doesn't really make a lot of sense. They were,
yeah,
Americans were buying, the refrigerators, the electronics, the
yeah.
TVs, agricultural produce. They bought everything cheaply with paper that cost nothing to print.
Yeah, what deficit spending really is, Clive, is living beyond your means, right? You consume more than you produce, and that's why we've got such a huge the U.S. has such a huge trade deficit and also a huge national debt. So the reason why I think Trump he's not really being honest, really, because you and I, we can see through it. He's saying, we've been screwed by foreigners, but I'm sorry, it's a two-sided coin. Foreigners also are holding a lot of paper dollars that are becoming worthless as well. And Americans, like you said, they were able to buy stuff just by printing. They didn't have to earn it. Anyway, Chris
I mean,
Conlon, let me just answer this super chat, Clive. Thanks, Chris. It says, what's stopping China from revaluing gold to current levels since the government and the citizens own the most gold per capita? Thanks. I think China values its gold at the market price. So I don't think it makes any difference. I think it's only the US Treasury that values gold at $42.22.
that's correct, Mario. China values gold every month at the market price.
Yeah, so I don't think it makes any difference there. Ian Myers, thank you for your super chat. I had to sell some gold last Tuesday. If gold silver ratio gets at 40 to 1, I'll break even. Interest on debt was too much. Do you think the ratio will come down? I'm sorry you had to get rid of your gold. Hopefully you'll be able to get some back. Uh, yeah, I think the gold silver ratio will drop back. It's not going to stay above 100 for too long. Clive, any?
Yeah, I mean, what you can do now, you can take the silver price, which let's call it $29 or something like that, multiply it by 100, you get to 2,900, which actually means that the ratio gold to silver is more than 100, which is a level I don't think we've ever seen that level before. Am I right, Mario?
I think we saw it during 2020, when silver dropped to like $12. So it was above 100. And I think during the crash of 29, during the Great Depression, it was very much near 100, but it's very rare to get it near 100.
I mean, I don't look. I mean, I know most people who are in the know think that the gold silver ratio should go back to, well, some people say as low as 15 to 1, which was, of course, the historical ratio back in the before the 1920s. I'm not sure we're going that close, but I certainly think that everything I see says that the ratio of gold to silver should be a lot lower than 100 to 1. So whether we get down to 70 or 50 or whatever, I don't know. But that basically means that silver would move upwards faster than gold in the long run.
Yeah, one thing I'm gonna say now, and then I'll let you end, Clive, is that this is like the third time that I'm going through this kind of scenario. I would say the first one was 2008. I already had gold at the time, and it didn't feel very nice. I knew that in September, when everything was collapsing, that it didn't make sense for the price to go down below 700, even though in 2007 it was like at 600, so it had gone up, but I sat through it. And then you had 2020 as well, when gold dropped from 1700 to 1450. Uh, and then all of a sudden it just zoomed up to like 2000. And also in '08, by 2011, it had went from 680 to almost 2000 as well. So, yeah, I think you just sit tight. And unless you think governments and central banks around the world are going to get religion and stop printing money and stop spending too much and stop wars and start being honest with citizens, then you sell your gold. But I don't see that changing, Clive.
Yeah, I mean, look, if you go to the shops and you buy a bar of chocolate and it's sitting on your shelf, and then you learn a week later that they've got a sale on the bar of chocolates half price, are you going to be sitting there saying, "Oh no, I wish I'd never bought that bar of chocolate"? No, it's still a bar of chocolate. It's still there, and a month from now that sale will not be on anymore, and it'll be back to the normal price. And the same applies to gold. Does it matter whether the price is higher or lower? What you've done is you've bought yourself a little bit of peace of mind, of security. An ounce of gold is an ounce of gold is an ounce of gold. Does it really matter if the price tomorrow is lower or higher? Because you didn't buy it, unless you're a speculator, you didn't buy it to sell it tomorrow. You bought it as a bit of personal security because you like the look of the gold, you like the feel of it, and you know that if the I won't say the S hits the fan, you know that it will come in handy to buy your food, pay your rent, do the kinds of things which you need money for because the money's going to be worthless at that point.
Yeah. Yeah, and you mentioned just a final word here because we're running out of time. You mentioned speculators, and that's what they want you to do. The banks and the governments with gold and silver, they just want you speculating. They don't want you buying physical. That's why they push ETFs, and that's why I'm very much against ETFs, even PSLV, even though they do keep the physical. But we've seen that they've been manipulating that PSLV by shorting the shares. So there you go, Clive. Any just final words that or thoughts that you might have forgotten and want to bring across?
Well, just a small comment on the tariffs, which I found quite surprising. Some of the tariffs imposed on various countries. I won't talk about Switzerland because I wrote about that, which I found very surprising because we're not currency manipulators. We have one of the highest currencies in the world. We have, very high prices. But So we buy a lot of American goods. But let's just talk about some of the countries which have really been hit. Take the Falkland Islands, for example.
Hmm.
So they imposed a 41% tariff on the Falkland Islands. So I looked it up. What does the Falkland Islands export to America? How are they abusing the American population? Well, I can tell you, the total exports from the Falkland Islands to America is a tiny $27 million. And guess what it is? Almost all of it is this weird fish called the Patagonian toothfish, which you can only find in the South American waters at a depth of about 3.5 kilometers. This is no competition for American fishermen, yet they put a 41% tariff on the Falkland Islands, where there's only like there's 3,000 people in the Falklands, and most of them are sheep farmers or fishermen. And then of course another one which amused me a little bit was Liechtenstein. So how is Liechtenstein, a little tiny country next to Switzerland, abusing America? What are they exporting to America that's in competition with Americans? Is it cuckoo clocks? I can't imagine.
No, what is it? Do you know?
I'm saying it must be
Yeah,
cuckoo
no,
clocks.
yeah. I mean, that's amazing.
I don't know what they export. I mean, Liechtenstein doesn't make anything.
No, no,
It,
no.
it's basic. It basically has banks. That's it.
Yeah, great. Clive, thank you very much, and I hope your back stays well. And I'd like to thank all the viewers for being here and participating, and hopefully we got a lot of your questions. I'm sorry if we didn't get everyone's questions, and I wish you a great week, and we're gonna see what happens in the markets. I don't think it's gonna be smooth sailing. Um, so take care.
Thank you, Mario. Thank you, all your
Thanks.
listeners.
Thanks, Clive. Let's end the stream. Okay. We got a lot of concurrent viewers, 2,700.